Hello, everyone. This is Kathy Fagan. I'm an annuity specialist here at Art Jetter & Company. Thank you for joining us today on this highly anticipated presentation from Athene. We'll be talking about the basics of annuities, including the annuity spectrum, advantages of fixed index annuities, and how to choose an annuity based on your client's risk profile. We're joined today by Scott McClure, Business Development Wholesaler with Athene. But before I turn it over to Scott, I just want to mention that if you have any questions throughout the presentation, you may type them into the chat box on your screen. All questions will be answered at the end of the presentation. So without further delay, here's Scott.
Well, thank you, Kathy. I appreciate it. Thanks, everyone, for attending. I learned a little bit more about Annuity Basics here. I am Scott McClure, your business development wholesaler with Athene. Very happy to be chatting with you all today. So without further ado, we'll just start out and we'll talk about how annuities work. First of all, why would your clients be interested in an annuity? Well, in 2016, there were over $220 billion worth of annuities sold in the U.S. $117 billion worth were fixed and fixed index annuities. The key reasons that clients purchase a fixed or fixed index annuity is primarily for safety and protection, and then also for income. So annuities are typically sold from the carrier through an independent marketing organization like Art Jetter & Company, through a broker dealer or a bank, to the agent or advisor, and then to the customer. So what is an annuity? An annuity is a contract between an individual and an insurance company. In exchange for the premiums paid, the monies may accumulate in the contract on a tax-deferred basis. They may be paid out all at once or in a stream of payments over time. So common uses for annuities are to save for retirement, one of the biggest, create a dependable retirement income stream. A lot of folks are using annuities for guaranteed income, and then rollovers from IRAs and 401ks. That is a big market where annuities fit in. The type of annuities available, we have deferred and immediate. Deferred annuities generally accumulate tax-deferred for more than 1 year before payments begin, often much longer than a year. A lot are 5, 10, 15 years. Some can be even longer than that. Payments can come via withdrawals or annuitization. An immediate annuity, that's simply turning a bucket of money into an income stream. Payments generally begin within 12 months of issue. We usually call those a SPIA or single premium immediate annuity. Annuitization converts an annuity balance into a stream of payments. Payments can continue for a fixed period of time or also guaranteed for life. So that depends on the settlement option the client would like to use. Additional purchase considerations on annuities, we have single premium versus flexible premium annuities. A single premium is purchased with a single lump sum payment. Some single premium annuities accept additional premiums during a short specified period of time at the beginning of the contract. What they're referring to is some annuities will allow you to add premium, for example, maybe in the first year of the contract and then no more. Flexible premium payments are accepted for longer periods of time, sometimes all the way through the contract surrender charge period. So again, that just depends on the annuity. Issue age guidelines, contracts often define minimum and maximum issue ages. And maximum issue age is often between 80 and 90. I know here at Athene, our highest issue age is age 83. So it does vary a little bit from company to company. And then let's talk a little bit about the tax basics of annuities. So accumulation versus payout. We'll talk about both of those. During the accumulation period, interest earnings accumulate on a tax-deferred basis. That is one of the great benefits of an annuity, is that it is tax deferred. No taxes are due until the funds are withdrawn. There's no 1099. It does earn interest on the dollars that would have been paid in taxes. So that money that you would have paid in taxes in something that's not tax deferred, you're actually earning interest on that as well. During the payout phase, if payments are withdrawn, earnings are taxable as ordinary incomes Earnings are always withdrawn first. Withdrawals before age 59 and a half may incur a 10% IRS tax penalty as well. That's because the IRS lets you defer paying taxes on those deferred earnings inside an annuity. If payments are annuitized, a portion of each payment is considered to be a return of premium. That's called the exclusion ratio. Also, let's talk about non-qualified versus qualified. On a non-qualified contract, it's going to be after-tax personal investment. The premiums are returned tax-free. The earnings are taxed as ordinary income in the year that the client takes those earnings out of the contract. On a qualified contract, which is going to be an IRA, a 401k, etc., usually funded with pre-tax dollars, all payments are taxed as ordinary income. The annuity does not provide additional tax benefits. Qualified money is already tax deferred, so what they're saying is putting qualified money in an annuity does not give you any extra tax deferral. So let's talk about withdrawal and surrender charges on these annuities. Most annuities assess a charge if withdrawals are made during an initial surrender period. Charge is typically a percentage of the amount withdrawn. Surrender periods vary by contract, and the most common surrender periods are from about 5 to 15 years, and they can be a variety of different lengths. Liquidity during the surrender period. Most contracts allow for some liquidity during the surrender charge period before the surrender charge applies. Free withdrawals of 5 to 10% are the most common. So again, normally in an indexed annuity, fixed annuity, you can take, generally speaking, about between 5 and 10% penalty free each year before there would be any surrender charges during that surrender charge period. Remember, all withdrawals are subject to tax on earnings, and withdrawals taken before age 59 and a half may be subject to an additional 10% excise tax. That is from the IRS. Again, IRS does have a 10% penalty if you take money out of an annuity before the age of 59 and a half. So let's talk about some additional liquidity provisions. There are waivers. Many contracts include special benefits to aid with financial needs that arise under various circumstances. The waivers may allow for penalty-free withdrawals up to specified limits if certain conditions are met. Common waivers include nursing home confinement, terminal illness, home health care. Waiver availability and terms may vary by company, contract, by state where the contract is issued, and by other criteria. RMDs, required minimum distributions. Tax code requires most qualified plans to begin paying income by age 70 and a half. Many issuers allow such RMDs to be taken without penalty. And then we also have income riders on these annuities. Many contracts offer income riders. That's optional benefits usually available for additional cost that guaranteed a specified minimum level of income, often for life. So again, they're talking about those lifetime income riders, living benefits that are so popular today as riders on income annuities. Let's talk now about some bonus provisions. They may apply under certain conditions. Common bonuses are going to be a premium bonus where an additional value is credited to the contract at issue. So sometimes you'll see a 5, 6, 7% premium bonus right up front. Persistency bonus, sometimes you'll see additional value credit if the contract stays in force beyond a specified time frame. And also income account bonuses. So additional value can be applied to certain withdrawal or annuitization payment options if they are elected. So we do have contracts where we'll give the clients a bonus on premiums as well as the income account value. That can certainly vary by contract and by state. So now let's talk about the guaranteed minimum withdrawal benefit riders. These are your living benefits, your lifetime income riders. Excuse me, a popular feature on many fixed indexed or variable contracts. They're usually offered for an additional annual cost, a rider fee. They guarantee a specified level of income, usually for life, applicable even if the contract value reaches zero. That is one of the true benefits of the income riders. Payable as withdrawal, not an annuitization, so the annuitant maintains control over the remaining contract value. The contract defines maximum amount available for withdrawal, often based on the annuitant's age at the time the guaranteed payments begin. Generally speaking, payout rates increase if income is taken at an older age. The length of time the contract was held before guaranteed income payments begin. Income factors typically roll up at a specified rate each year. That's how our contracts work. The longer your clients defer taking the income, the bigger their income account value will grow to, and also the higher the payout percentage will be. Excess withdrawals may decrease the value available for subsequent guaranteed payments. So that's very true in most contracts. If your clients do take excess withdrawals, that can reduce the future lifetime income payments. So talk a little bit about death benefit. Death benefit, if an annuitant dies before contract maturity, generally bypass probate if properly named beneficiaries. It's one of the great things about annuities. If you have named beneficiaries, you can bypass probate and just go directly to the named beneficiary. Paid directly to the beneficiary or beneficiaries in a lump sum over periodic payments. Some are paid out over 5 years, or lifetime payments are also available under certain contracts. So let's take a look now at the type of contract. We do have fixed annuities, we have fixed indexed annuities, and also variable annuities. So on a fixed annuity, the owner earns regular interest, the company declares the interest rate, and the company may offer multiple terms, usually 1 year or longer. Example with Athene, we have a 3, 5, and 7 year just straight fixed multi-year guarantee product. Also, fixed index products, excuse me, those are the most popular, it seems, in the market right now. The owner earns regular interest. The interest is based on a portion of the return of one or more indices. So the company defines how the index earnings will be shared, and the company guarantees that interest credits will never be less than zero. So one of the great benefits of a fixed indexed annuity is that you have 100% downside protection. Even if the index goes backwards or loses value, clients will not lose value because of that. That's where we say zero is your hero. So then we also have variable annuity contracts where the owner may earn interest depending on the return of sub-accounts. Those sub-accounts will actually be invested in the market. Sub-accounts are similar to mutual funds and may rise or fall in value. These are going to be picked by the client or the client's advisor, and the investment risk in a variable annuity would be on the client. Variable annuities are considered securities and require a securities license to sell variable annuities. So now let's talk about interest rates, fixed rate annuity basics. Initial rates, the company guarantees that the initial deposit will earn a specified rate for a specified period, usually 1 year or longer. Renewal rates after the initial guaranteed period, the carrier will declare new rates for subsequent periods. A lot of times it'll be just a 1 year rate, maybe or higher or lower than the initial rate depending on the interest rate environment, and may have different terms than the initial period. Again, some contracts offer multi-year initial periods, but only 1 year renewals. So that is how they can work generally speaking. Minimum guaranteed value. The company declares a minimum guaranteed rate below which the crediting rate will never fall, established at the time of purchase and applies for the life of the contract. Now we'll talk a little bit about market value adjustments. That's a charge that may apply when money is withdrawn or transferred before the end of the guarantee period. It's defined by the company in the contract, typically related to changes in interest rates over time. In general, if interest rates have risen since the guarantee was established, the MVA will result in a charge or deduction to the contract value. If general interest rates have have fallen since the guarantee was established. So if interest rates have fallen since the guarantee was established, the MVA will result in a credit or an increase in the contract value. So here is the spectrum of potential annuities and the risk that goes along with them. So some of the things you can invest in that are low to moderate return and very low risk are going to be CDs, bonds, and fixed annuities. With something with a little bit more moderate return and no market risk is going to be a fixed indexed annuity. So safety and potential growth is available in that fixed indexed annuity. And then For potential of higher return, you need to take a higher risk, and that's going to be generally your variable products, stocks, bonds, mutual funds, and variable annuities. Again, that's where you have all the investment risk on the client. So fixed indexed annuity basics, let's talk about a few terms. As with fixed annuities, indexed annuities include term lengths, generally 1 year or more. We generally see these from about 5 to 15 years. Initial cap rates assigned to the annuities contract at the time of purchase, applicable to the term selected. Renewal cap rates declared after each index term, applicable to the next term. So you may have a client that has a 1 or a 2 year term. They will get a rate initially for that, and then when it comes up to renewal rate, they can get a new rate, can be higher or lower just depending on the interest rate environment. Minimum guaranteed value declared at contract issue and applicable for the life of the contract may be set by a formula. So just to kind of go over our main product line, which is fixed indexed annuities, it is not invested in the stock market. That's a misconception sometimes, that folks think that fixed indexed annuities actually invest in the index. It is not invested in the index. We actually are just tracking an index to give the clients an interest rate. So with fixed indexed annuities, interest rate is linked to the portion of the upside performance of an outside market index. Potential for greater interest crediting compared to traditional fixed annuities is available in fixed indexed annuities. The indices vary by company and by product. Some of the most popular ones, most common ones, are certainly going to be the S&P 500, the Dow Jones Industrial Average, NASDAQ 100, Hang Seng, Euro Stock 50. There are a variety of different indices available now in fixed indexed annuities. So let's talk a little bit about index interest crediting. The index may move up or down. The accumulated value of the annuity increases as the index interest is credited based on upward movement of the index. It's linked to, but not equal to, the market index return. There are a few different ways that we will credit interest in a fixed index annuity. We'll talk about those shortly. The accumulated value does not decrease if the index movement is negative or flat. So that's where you have your 100% downside protection on fixed indexed annuities. Clients did not lose any value based on the movement or downward movement of the index. Fixed indexed annuity basics. Let's talk a little bit about how the interest is credited. We've got caps, we have spreads, and participation rates in our rates on fixed indexed annuities. On a cap, the interest credit equals the return of the underlying index up to the stated cap. So for example, if the cap was a 5% cap and the index returns 3%, the client would get a 3% interest. If the index earned 5%, the client would get a 5% interest. If the index earned 9%, because we're at a 5% cap, the client would earn 5% interest because that interest is capped at 5%. That's how a cap works. We also have something called a spread, and these can be used together. We don't use a spread much here at Athene, but the return of the underlying index less the stated spread is what the client will earn. So for an example, if we had a 2% spread and the index earned 3%, the client would be credited 1. 3 minus that 2% spread is 1. If the index returned 5%, we'd credit the client 3%. That 5 minus the 2% spread is 3. And then again, if the index earned 9%, the interest credited to the account would be 7%, 9% minus that 2% spread. So that's how spreads work. Participation rates, this is what we use the most here at Athene. The interest credits are equal to the return of the underlying index multiplied by the stated participation rate. So let's take a look at an example where a participation rate is 50%. If the index returned 3%, the client would earn 50% of that, 50% participation in the index, and that would be 1.5%. If the index earned 5%, the clients would earn 50% of that, 2.5%. And if the index returned 9% at a 50% participation rate, the clients would earn 4.5%, again, 50% of the 9%. That's how participation rates work. So Index interest crediting strategies. Approach used to measure the amount of interest credited to the annuity as a result of change in the index. So common strategies are going to be, we see a lot of, every contract normally has just a straight fixed rate, a 1 or 2 year guaranteed rate, also a point to point. We're going to take a look at where the index is on the anniversary date, and then increases from a specific date to 1 year later. For example, if the contract was on June 6th, we would take a look at the amount of gain between June 6th and the next year, and then the client would get that amount of gain based on how that index performed. Also, we do have monthly averaging. We look at the percent of change in the index, comparing the beginning index value to the 12-month average of the index values, and then also a monthly cap. So it works the same as the point-to-point strategy, but on a monthly basis. After 12 months, we actually get a point-to-point on each month, and then we add up after 12 months, we add them all together and divide by 12, and that gives us the average monthly cap. So just a few different crediting strategies. So to summarize the annuities, you get safety and protection, provides upside potential with no risk of loss. Income is available on certain contracts. You certainly get tax deferral in all annuities. You have death benefit options. That's going to vary by the contract, and liquidity options will also vary by the contract. Again, you have penalty-free withdrawal amounts, free withdrawals, nursing home riders or waivers, terminal illness waivers, confinement waivers. Those are very common in annuity contracts. So at this point, Kathy, I am going to open it up for any questions we might have. And I would just say, if anyone out there has any questions about the annuities, give one of the great marketers at Art Jetter and Company a call. They'll be able to help out going forward. They're always happy to answer any product questions on any annuities that they are able to help out with. Again, at this point, Kathy, if we have any questions, I'll be happy to answer them. I'll throw it back over to you.
Okay. Nope, not seeing any questions on this side of things, Scott, but want to thank you for your time today, as well as everyone that joined us on the webinar. Want to encourage all of you to start thinking about people who are a fit for some of the solutions that we discussed during today's webinar. As Scott mentioned, our team is standing by. If you have any questions, any clients that do come to mind, you'd like any of these solutions illustrated, or just some additional training regarding these products, give us a call. Again, thanks everybody for attending, and enjoy the rest of your day.